We're joined this morning by Vikas Khemani, who's the founder and CIO of Carnelian Asset Management and Advisors. Vikas, as always, absolute pleasure speaking with you and good morning to you. What I found very interesting of the various things that you post on your handle recently is this post that you had on the Tata Capital IPO, and you spoke about the fact that people have bought in the unlisted space at levels of 1,050, IPO price at 326 rupees, and they're probably regretting things right now. Would you explain to my viewers what this is all about in your opinion? This is an element of FOMO, people trying to get in ahead of the IPO.
Good to chat with you always. So if you see, I think in last 1.5 years specifically, there was a big fad getting built about buying into unlisted shares, and I think it was kind of created post success of investing into unlisted shares of the NSE success, right? And as a result of that, many investors, not so qualified, not so well aware, ended up buying into the private markets of many companies, which included likes of Tata Capital. We saw in 21, a lot of new tech companies were being bought like this, whether it was Paytm, Swiggy, or many more. And same thing last 1 year, we saw similar thing happening in case of HDB Financial Services and like this. So I think very often when people are buying and the new approach gets created that private markets make more money than listed market, and that's completely untrue or far from truth. Actually, what makes money is when you buy a company at the right price, right management, and right business model, right, which could be listed or unlisted. And as an investor, you have to always look for the risk reward of investment after understanding the investment hypothesis. Whereas I think we know that if you are buying Tata Capital at 1,000 rupees plus, you can imagine that the person who's buying has no idea about what valuation is paying. He just bought the name, and I think some people have kind of, I'm sure, coaxed them into it, or, they kind of got themselves into it. But, they did not understand what the price book is, what the valuations are. They just saw Tata Capital is available and should buy. And that's happening very often. So, the private investing into the private markets is a kind of fad which is going on. A lot of people are having FOMO, and I think like everything else, these kind of cycles fade away. And if you analyze this particular case, by that time, I think probably stock will not come to 1,000 rupees in the next 5 years. And so you are sitting on a 6-7 years of no return. What's the point? So better you do what you understand and understand what you do before investing. And that's the point I always kind of tell whether our investors or people at large that investing is understanding risk reward, understanding what you're doing rather than just kind of investing out of hearsay or somebody else's recommendations.
Okay, Vikas, morning, Hiral here. So clearly, you've identified the weak point over here, that one, you're not going to see that kind of returns even come back in the next 5 years. So the investor really is sitting stuck with that kind of investment. What are the weaknesses that you're seeing for a Tata Capital taking this 5-year gestation period into consideration?
Comment is not in particular way to specific to Tata Capital. My comment is more in general that before investing into private markets, understand what anything please understand. And specifically, I highlighted because these days it's fancy to invest into private market unlisted shares. And if you do that without understanding that, then you will have to live with the downside. Tata Capital, it's a good company, run from the house of Tata, so you can't argue about anything. It's a decent business model. AAA and NBFCs, this are liking. The only thing is we always look at with the risk reward perspective, and our topic in that has been for quite some Aditya Birla Capital, and we still find risk reward compared to Tata Capital better there. They're far cheaper, better ROE and better growth profile. So I mean, you constantly look at when you are investing, what are the options available, and within that, where does the risk reward lie more, rather than just looking at a particular name and evaluating that.
Yeah, Vikas, good morning, Neeraj here. I heard some very good things about the LG IPO though, and that was interesting to me today. But the one facet about IPO investing, Vikas, that I just wanted to check with you, it seems that gone are the days wherein if an IPO is subscribed some 70, 80 times, that would guarantee a good listing and a subsequent follow-up. The initial demand when the paper is up for subscription is not indicative of the appetite post-listing for some of these companies. Would that be a fair assessment? Why or why not?
Really, this depends on the company sector. If you have one of the Me Too company coming in the market reasonably priced, why would why would you see a pop-up, right? So how much valuations you are leaving on table, right? And if it is, let's say, Me Too company, and if it's a new company which offers something reasonably well, a segment which you are not, let's say, otherwise able to get. Let's say, for example, recently CP Plus got listed, and that's a very unique proposition, right, in the self-reliance theme, and you saw good pop listing, right? But at the same time, there are many companies which has no differentiation, there's just hitting market and fairly priced. So it's really then our rule of thumb is that we don't look at very aggressively IPOs in when markets are very good. Right now, we know that there's frenzy of IPOs going on, and you need to really see good risk reward, reasonably good, money on the table before you get in. And that's kind of reasonably less and that's when you find this kind of tepid response.
Because that last point is what I want to drill down on, because I was speaking to a couple of large asset managers in the mutual fund space as well, and they're saying that they're not really participating in IPOs or any other promoter issues either, because they're just saying that there is no value to be found. And just to drive home that point, why do you think that is? Is it because of the kind of domestic flows that you've seen? Of course, SIP books remaining strong, so therefore there are buyers at pretty much every level, and a lot of investors squeezing value out at the IPO stage. Is that the reason?
Still, it's a very general thing.
Yeah. But I'm
boils
saying
down
more
to
often than not. I'm saying, 8 out of 10 times, 9 out of 10 times, you're seeing that happen now.
we've seen reasonably large participation coming from mutual funds also. It's not that, whenever there's an interesting idea, all of them participate in fairly aggressive way, because IPOs are also a great way to get access into a company which is otherwise not available in the market. So I would not broad brush it, but yes, whenever there is a apparently nobody will claim it, but apparently the intent of the issue is either to just list or sort of do some OFS for promoters to get money. Then you have to really be very careful what is the sustainability model, and also we must not forget that around the IPO, around any transaction, typically managements tend to overhype and tend to oversell and create a huge amount of interest around that, and that kind of pushes the price up. So one has to be very careful about any of the transactions which comes about, and we generally look at with a very very high bar on the risk, and only reason why when we participate is when we are getting something very unique at a reasonable price.
Because what I meant to ask you, sorry, was just this, that what I'm seeing is companies seeing a subscription of 60-70 times when the IPO is up for subscription. Normally in the past, that used to be equated to a good listing and a good life after that. We're not seeing a pop on listing these days, which is also fair. I mean, I would love to know why, but which is fine. The market mood is subdued, etc. But if a company is seen 70-80 times demand for the paper when the IPO is on, how is it that there is no demand for the same IPO price listed stock after the listing? That is what I'm kind of grappling with.
Simple. I think again it's a very generic thing, but possibly it could be also that company is a generic company, and also a lot of 10-12% flippers might come in and then they might get out. So that it might appear that because these days a lot of banks apply leverage. These days a lot of mutual funds are sitting on cash. They might just take a call saying that I might get small listing pop rather than remaining invested into liquid, and that kind of behavior might be able to explain, but this is not really one can't really generalize in it's company specific. But I would say not serious money might also lead to some sort of all subscription in these kind of times when people are sitting on a large amount of cash, and even if you make 5-10% pop, it's a good money vis-a-vis liquid. That could be explained, but again it boils down to the company specific issue.
Vikas, thank you for that. I think that is good advice as well when you're talking from the unlisted space perspective and what's happening specifically with regards to the bigger names right now.